And today, of course, it's Chandrakant's lucky day. Well, he's 35 years of age and he's employed and he's got a long-term time horizon on his 8th stock portfolio. Let's quickly take you through the stocks that he's got. Well, he's bought a Reliance Capital at an average of 381 rupees. So he's got 125 shares of that. He's also got about 50 shares of State Bank of India. He's got about 25 shares of Larsen & Toubro, picked up at a price of 1,532. About 1,000 shares of Dish TV, that's been fetched at a price of 71 rupees. Well, Tata Steel also features on his list and he's got about 100 shares of that at an average buy price of 337. He's got about 50 shares of a Lupin at 688, and from the mid-cap capital goods space, but then he's got about 100 shares of BGR Energy at a price of 346, and just a very measly amount really of Reliance Industries, just about 5 odd shares at an average price of 873 rupees. Mr. Chokkalingam, before we start analyzing, of course, each of those stocks in greater detail, of what I can sense from the portfolio is that he has taken exposure to some of the blue chip names. Of course, you've got frontliners like State Bank of India, Reliance Industries, but even in the mid-cap exposure, he's got a Dish TV. So some of the quality mid-caps really are featuring here.
That is true. Individually, many of his stocks are a good selection, no doubt. But for his age, if he starts a very conservative approach to portfolio management, right from the beginning, he can definitely grow his wealth consistently over the years. Because, for instance, if you look at the portfolio, he has got huge exposure to few individual stocks and one or two sectors. For instance, SBI alone has about 33% weight in the overall portfolio. And if I add Reliance Capital, then the banking and financial alone have about 46% exposure in the total portfolio, which is not good. If something goes wrong for the sector, then the portfolio, the wealth can erode substantially. So therefore, he should have a limit on individual stock as well as individual sector. And third, he should also have at least 40% of the weight towards good quality mid-cap stocks where the management issues are not questionable at all. Because in my learning, rarely any stock debuts in the stock market as a large cap. Almost 75 to 80% of the stocks which have become large cap, they are debuted in the stock market as mid-cap stocks. So since he is around 35-year-old now, he should share this experience and then start building good quality mid-cap stocks at least to the extent of 40% and try to create substantial wealth over the years.
So being selective while picking your stocks and of course diversifying in terms of sectors as well, that's really the key advice that Mr. Chokkalingam has for you. But Chandrakant, we'll also of course get all your individual stocks analyzed. So let's pick up the first two. Reliance Capital at 381 as well as the State Bank of India where he's firmly in the money. Mr. Chokkalingam, what would you advise?
I would suggest hold on Reliance Capital. In fact, I would suggest that he holds on for 2 years so that he can try to reach 585 rupee target. I'm saying 2 years because the insurance FDI bill is yet to be passed by the parliament. Perhaps it may not be passed by the present government. In case it is delayed, certainly next year when new government comes in, it is possible for government to pass the bill. And that will be a major trigger for Reliance Capital because it has got both insurance and general life insurance and general insurance business, where it has committed to sell only 26% now. But then once the bill is passed, it can sell 49% and unlock a lot of money. As far as SBI is concerned, I am not positive on the bank because its gross NPA as of December 31st is more than 5% and a huge bad asset on the book. I would rather suggest selling SBI and move to safer stock, and I consider Karur Vysya Bank as the safest banking stock because it's around 95-year-old bank. Like City Union Bank, Karur Vysya also has created a lot of wealth, whatever time frame you take, whether 3 year, 5 year or last 20 years. So you should shift from SBI to Karur Vysya. In fact, Karur also has got least net NPA on its books and it's a consistently growing bank.
Okay, so that's the change in your first set of stocks, Chandrakant. Let's get to the next two then. Larsen & Toubro that he's fetched at 1532. So not making too much money on that one, but a Dish TV at 71, a hefty quantity, and he's also losing out money.
He should hold on to L&T because I firmly believe that a reversal of interest rate cycle would continue. That would be favorable to L&T. And as far as Dish TV is concerned, I would suggest shift from Dish TV to Eras International. Because in dish TV industry, the competition has increased. This company has lost out. Though it's a pioneer in the business, it has not turned around completely. And whereas Eras International, it's a least leverage. If you take last 5 years, its profits have gone up by almost 3 times. It's almost consistently growing in profits. And I firmly believe that the Eras Media can give a very good return in the next 1 year. So I would suggest switch from Dish TV to Eras International.
So stay on in L&T and switch from a Dish TV. What about a Tata Steel? What do you make of his buy price here, as well as a Lupin? Pharma has of course had a stellar run over the last week, 10 days, or even for the last month. The rally really has been taken away by Pharma only.
Yeah, certainly. The valuations of pharma companies are little stretched, no doubt about it. But still, he can hold on to Lupin. I firmly believe that one can get another 100 rupees rise. It's highly diversified across various geographies and various therapeutic groups. And hence, the impact of pricing policy in India is also limited. And therefore, he should hold on to Lupin till he gets, our targeted price.
And what about Tata Steel then?
I am negative on Tata Steel. I firmly believe that, the Quares acquisition is a big negative because it doesn't have cost advantage either in terms of the resources like iron ore or coal or in terms of the labor cost, nor the market in Europe is conducive or comparable comparable to Indian, steel industry or Indian economic growth. So therefore, I would suggest shifting from Tata Steel to safer metal stock like Hindustan Zinc. In terms of 1 year forward earning, it's quoting at around 6 PE. Huge cash on the book. Cash itself is around 45% of the total market cap. And zinc, has got a better prospect than steel, particularly in European steel industry concerned. Zinc is a safer metal business. So therefore, I would suggest shifting to Hindustan Zinc. Also, there is a tactical opportunity. The actual floating stock, if you exclude government holding and Vedanta Group holding, is very small. So the moment the divestment happens, the stock really can flare up and it can get re-rated.
Okay, so multiple triggers in the works possibly for a Hindustan Zinc, which of course is a replacement for Tata Steel. Let's focus then in on a BGR Energy from the capital goods space. It's not had the best of runs. The power sector as a whole, of course, has been in the doldrums, and the flow down, in fact, has come to some of these, power equipment providers like BGR as well, Mr. Chokkalingam. Also, a Reliance Industries index heavyweight really hasn't done anything at all if we look at even the last 1 year.
Certainly. BGR Energy, I would not have bought the stock because I'm not comfortable with the balance sheet. If you look at the balance sheet of last year, almost 82% of the total capital employed by the company is shown as a sundry debtor. It's not the efficient way of running the business. Maybe it is perhaps the nature of the business, but still it is not giving any comfort at all. However, since he has already lost and losing a lot of money, on the other hand, as I mentioned earlier, the reversal of interest rate cycle is expected to continue in a significant manner. There would be definitely overall upside for entire cap goods sector. Therefore, he can hold on to the stock. Reliance Industry, along with the capital goods segment, it has been suppressed in the stock market for the last 3 years. Its market cap is nowhere if you take a longer time frame. And however, I firmly believe that the long-term bearishness for Reliance Industry is over. There are enough triggers for the company to come out of this long-term bearish phase. One, unlocking value potential from retail business. Two, the unlocking potential from the telecom. And third, the opportunities from the shale gas in the US. And fourth, the gas price revision expected next year. Definitely, we expect at least around a 60% revision in the gas price. So all this would act as a major trigger for the company. And I firmly believe that in next 2 years, the stock in fact can even go up to 1500, partly because of the growth and the earning expansion and also the PE multiple expansion, which I anticipate due to this unlocking potential. So therefore, you should hold on to Reliance Industries.